Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:26 a.m. Central Time, and I am recording this in preparation for the market day of October the 23rd, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So, what happened in our overnight? Well, generally positive. In fact, the S&P is up about 18 points, almost 0.9 of a percent. The Russell's also up 0.9 of a percent. Nasdaq even more bullish at about 1.5%, and the Dow up just under 1%. So big night for all four U.S. broad market indices. Crude oil's up over 0.5%. Euro's down just marginally. Bonds are down about 0.8 of a percent, and gold is up over 1%. In overseas action, China is up about 1.33%, as is Hong Kong. Japan is up over 2%. Germany up 2.74%, and the United Kingdom up about 1.35%. So, really big night all the way around the globe, and consistent also. So the things that are need to be up big in a bull market are, and the things that would be expected to be dropping in a bull market, risk on market, such as bonds, are down. So things are certainly very bullish and consistently bullish. In terms of the macroeconomic reports, for the U.S., there's really nothing of note today to push anything. There is a flash manufacturing, but that's only a yellow flag report. In terms of current volatility conditions, as you would expect with Big Bull yesterday, these conditions have ebbed even more. Short-term VIX is down to a 13. The skew has also been dropping. It's only a 121 at this point. IV percentiles, S&P 11, Russell 16, Nasdaq a 9, and Dow a 16. We had two standard deviation moves put in on three of the markets yesterday: the S&P, Nasdaq, and Dow. Only the Russell was missing. And remember, the Russell had the big two standard deviation move the day before, so it kind of was already out in front of the move that was put in by the other indices yesterday. In terms of our regular daily report, we continue to believe that this is phase 3 bull flag, so pullbacks will be shallow and bull runs will be deeper. But there are some warnings in the mix that still remain. It's hard to call this an all out, all bull market all the time. Indeed, IBD status has it as confirmed uptrend with a accumulation distribution score on the S&P of a B, but the Nasdaq a D minus. GMI index a 6 out of 6 with a buy signal since 1019, but that author continues to remain in cash in his portfolio call. Primary market condition is a weak bear, as in the relationship of key moving average lines. We do have some updates on the decision point stock charts. You notice now that we've started to see more up arrows on the intermediate term across the different indices. Not universal. So you got trend model signals, but not PMO signals. But it's still it's a significant upgrade from where we were. Notice that the long-term signals are still generally down. So kind of like what we're talking about on the primary market condition being a weak bear. But still, improvement there. Intermediate term market posture is very bullish with an upslope sentiment. When you put the consensus of all this together, you have to say that while we might still be in something of a transition, that transition word is becoming much less apparent, and it's more like this has been a giant consolidation pattern, and we're starting to move out of it into the bullish phase. Indeed, let's take a quick look at the charts. Recent days action has been pretty interesting, and we talked about the various lines in the sand as we came off of this essential double bottom pattern, with the first line in the sand coming back up to the bodies of this area here, that resistance, and you saw it stalled there briefly but then went through. The second line in the sand being the FOMC pattern, again a stall and pull back and then through. And then the next resistance area was this bottom of the prior range, and you see we have now closed back into the prior range. We needed to be up above about 2050, and yesterday's close was 2055. So we are through all those lines in the sand. Along the way, there was also some key moving average lines that had to be broken through. So you have to give it to the bulls that while the expected stalls or even pullbacks happened as it ran into these various resistance zones, it has in pretty short order powered, usually within a couple days, 2 days here, third day here, fifth day here, that it would be 2, 3, and 5 days to go through these areas. Not surprising because these were important areas of resistance, but the bulls didn't take too much of a pullback before they powered through on large candles. And you notice here, fairly significant body candle, very significant body candle here, very significant body candle here. So each time powering through that resistance on a fairly significant large body candle with significant volume. Indeed, when you look at the distribution patterns and so forth, and our distribution K count for the Nasdaq's a 5, well, some of those distribution days were relatively weak quality, as in the way that's calculated is, it's percent move down versus the day before, but the day before was really weak volume, so it wasn't hard to hit the threshold of having an increase in volume on a down day. So all in all, this pattern of come up to resistance and then power through in relatively short order is pretty impressive. So here we are back into the prior range. You have to say the bulls are in control, and that we've got to start to respect that more and more. Well, that being said, there are still some warning signs that we have to pay attention to, but they're not terribly pronounced. The intermediate term market posture is very bullish, and indeed 3 of the 4 are in the very bullish camp, S&P, Dow, and Nasdaq, but the bears still are having trouble with the small caps, and the Russell is actually turned bearish with relatively weak performance yesterday. You also have position sizing opinions at 100% on both, and we used to say at the beginning of this to be relatively cautious, perhaps defensive with some of your initiation positions. That would seem to be coming into a phase where you would want to be a little bit more just outright bullish. Hedge warning status remains at threshold level 1, yellow light, so there's some risk element still in play, and we frankly agree with that when you take all this together. That certainly would seem to make sense, but start to be more and more bullish in your bias. You see the volatility base elements. We had a couple of these that were warnings earlier in the week have come off. You see the distribution day count on the Nasdaq, but we mentioned that some of that count may actually be somewhat questionable in its count. New York Stock Exchange new highs, new lows. Good day put in yesterday, almost 5-to-1 in terms of new highs to new lows. In terms of intermarket risk aversion indicators, only one as risk off, the others are on risk on. Special opinions. VIX is within the acceptable window for novice traders to initiate option income strategies. And we still have this about current skew, and the current skew is elevated. We would start to minimize that a bit more. That seems to be starting to ebb off. Cover calls also cautiously bullish. Use a 2-to-1 ratio of out of the money and in the money, so starting to be more bullish there. Also, the 2-to-1 ratio in the high beta, low beta. In terms of put selling, um, you can certainly use defined risk positions, and as always, make sure that you're position sizing in the position size that you are willing to own. So don't sell more contracts than you're willing to take in shares. Aggressive traders can consider scaling into more full positions, um, but take a little bit more bullish bias on all this language here than perhaps we would have a few days ago, as we have broken through these areas of resistance and moved into that prior range of the trading that occurred before the August breakdown. In terms of sector specific, you see, other than healthcare, and of course healthcare again took another hit yesterday, especially the biologics. Abby and so forth had an FDA warning, and you know, a number of things came into the biologics again, biotech, I should say, and that continues to be a sector that is really struggling. Retail, of course, continues to be a sector that is struggling with digestion of these increased costs against not increasing revenues to match the what's necessary to offset those costs. In terms of sector percent, very big day. You see only healthcare, and we talked about the problems there. But all the other sectors were up, and not just up, but up very big, anywhere from 1 to almost 3%. You're also starting to see more consistency in the 1, the 5-day, the 1 month, and even into the 3 month now, starting to show green. So these are certainly marks of a healthier, bullish posture, and you know, needs to be respected. Okay, that should be enough for today. As always, if you find what you're getting from here is helpful to your trading, we appreciate you subscribing to our YouTube channel. That gives you the opportunity to get notice as soon as it's been posted each morning before the market opens. And then, of course, like us on YouTube, retweet us to your Twitter followers, to your StockTwit followers, etc. Email support can be found at support@falconglobaltraders.com. And some special opportunities. You can take a look at this at your leisure. There's more information at this website, and also here at this website. Opportunities here with Falcon Global. Disclaimers as always. Hit the pause button if you need more time to review. And we look forward to seeing you back here Monday morning with the Falcon Global Market Preview. Good trading.